Bank of Uganda has raised the September central bank rate from 11% to 12%, which it represents serious worry to the common person in Uganda. The last time the central bank announced a rise in the central bank rate, it meant increased cost of finance with high interest rates on private sector loans, high cost of living, high rate of non-performing loans, and business collapses. The central bank introduced the monetary policy to check the galloping inflation, which hit 30.4%. the highest in 20 years' time. The commercial banks responded promptly with high interest rates on new and running loans. This was the central bank basic interest to reduce the rapid growth of credit and encourage savings for a better exchange rate. The inflation pressures abated and the central bank eased its monetary stance by reducing the central bank rate as low as 11% last month. But now that the inflation rates presented an upward trend last month, resulting from the supply-side shocks to agriculture, the monetary stance is again tightening.
I believe that it is warranted to raise the central bank rate by 1 percentage point to 12% in September 2013. Although annual core inflation will probably remain above 6% for the next few months.
Emmanuel Mtebile, the Governor Bank of Uganda, warns that commercial banks should not choose the 1 percentage point rise of the central bank rate as an excuse to raise the already high interest rates on loans. The central bank had begun to realize good results from the campaigns to empower commercial banks to reduce interest rates, but the food inflation that pushed high by 16% last month alone might change the trends.
PR will remain at plus or minus 2 percentage points, and the margin on the unit discount rate will be 3 percentage points on the CPR.
According to the central bank, core inflation is likely to be pushed up in the next 12 months. This is also prone to affecting real growth for the next financial year. But the central bank predicts that the threats will not repeat the 2011 scenario, where inflation hit 30.4%, the highest since 1993. This is because the factors that influenced inflation then, such as rapid bank credit growth and large exchange rate depreciation, are not yet threatening.
A modest tightening of monetary policy should act to discourage economic agents from raising non-food prices in response to the food price shock, and should counter any rise in inflationary expectations.
But the central bank is also working out efforts to ensure that the food inflation does not spill over to non-food items through the second round effects. A modest tightened monetary policy is to be implemented to discourage the increase of non-food prices. The Uganda Bureau of Statistics last week announced an acceleration in inflation, with the annual headline figures rising from 5.1% in July to 7.3% in the month of August this year. Nakwanga News Kasirye, Irene Namaja, NBS Television Business.